Well, for more on China and its economy, I'm joined by Shuang Ding. He's Standard Chartered's Head of Research for Greater China. Welcome to the show.
Thank you.
Now, let's start with an overall look at the health of China's economy. How would you characterize its performance in the first 3 quarters?
I would say the economy is on track to reach the government target of 6.5 to 7%. And the first half of the year, the GDP grew by 6.7%. And we see some pickup in the third quarter and most likely in the fourth quarter as well. Most likely the economy can grow by 6.8%. That's our forecast. But it also comes with a cost. For example, China is running a higher deficit, and the debt to GDP ratio continues to rise because credit continues to grow faster than the GDP. And also the private sector investment remains quite sluggish, possibly crowded out by the public investment.
Now, you mentioned the issue of debt, and the IMF recently said that China's dependence on debt was, quote, growing at a dangerous pace, and it really wanted them to act before it becomes a crisis. What's China doing to really tackle that debt crisis?
I think it's a concern for the market, and increasingly it's a concern for the government as well. So deleveraging has become one of the top priorities for the government this year. But I don't think deleveraging is possible, at least in the next couple of years, because China have the growth target and they need to provide sufficient credit to support that growth target. So I would say the risk will continue to increase, but I don't think it will cause a Lehman type of meltdown in the case of China, mainly because China's capital account is relatively closed, and most of the debt is domestic debt.
Now, some of that debt that we're talking about, also we heard in the report about property prices heating up, and we saw that cities are really taking steps following Beijing's lead of restricting home purchases in order to curb some of this speculative buying and really cool prices. What are the risks then if the property price of the property market continues to heat up?
Well, I think at least we see the rents are going up, and that will fuel inflation. And that will increase the cost of living and affect China's competitiveness. But from a more broader perspective, a higher home price will lead to, I think, a lot of resources to channel to the property market. That will derail China's economic restructuring. China wants to move up the value chain, but if the resources, including financial resources, just flow to the property sector, that won't help.
So then what could it be taking away from then? If we're seeing these resources, as you said, going towards the property sector, who's going to be losing out then? Who could be weakened in that?
I think the real economy, for example, if the return from the property sector is so high, the private sector, has no appetite to invest in the real economy. So, but I think there are solutions to this issue. And for example, in the first-tier cities where supply is a problem, the government really need to increase the supply of the land. And also, I think they can introduce some prudential measures like the down payment requirement, keep a more neutral monetary policy. That would also help. But more fundamentally, I think China needs to introduce property tax to increase the holding cost of the property.
Now, let's also look at some of the bright spots. What are some of the emerging industries that are perhaps heating up at the moment?
We monitor China's service growth on a monthly basis. I think that is a stabilization factor for China's economy. And according to our tracking of the high-frequency data, that sector is growing at 7.5 to 8%. And the service sector now accounts for more than 50% of GDP. So that contribution helped to sustain China's growth. And within people talk about overcapacity in China, mostly in manufacturing industry. In service sector, there is a lack of capacity, lack of supply, and a very strong demand from the population.
Now, something else I want to get to. We know that the RMB was recently added to the IMF's special drawing rights basket of currencies. So with this increasing globalization of the RMB, what impact do you foresee that having on the Chinese economy?
I would say that this is not only symbolic, it's quite substantial. A substantive result will follow. This first is this basically gives RMB an international reserve currency status. And we expect the foreign central banks to start diversify their reserve holding into renminbi asset, because renminbi asset will be recognized by the IMF as the official foreign exchange reserve. Our expectation is in 5 years, the renminbi share in the global FX reserve, excluding China's reserve, could reach about 5%. So that is very similar to today's British pound and the Japanese yen. And that would be equivalent to about $300 billion inflow. And in the near term, that can help to counter the capital outflow that has been happening in the past year.
Certainly something that the economy has been contending with. We'll have to leave it there, unfortunately. Shuang Ding, thank you for joining us. Standard Chartered's Head of Research for Greater China.